Hey everyone, this is Prashad Parthiban. Today I'm going to cover what do you mean by management liability policy. The name itself clearly states if there is any liability when it comes to management, we use this policy. So let's see some examples. So management liability policies in turn as 4 insuring agreements. When I say 4 insuring agreements, different categories of policies. The first one is directors and officers liability insurance. Most of us know if I have a company, I can have directors, officers who are appointed by the company, presidents or owners. Now, if they do some kind of wrongful acts, when I say wrongful acts, it could be misleading statements or some kind of errors, right, or breach of duties. It is very highly possible the customers of the company or the shareholders or the vendors can file a case against them. In those cases, it have happened where they have end up paying 2 million, 3 million of losses, right? So that's the reason why they have introduced this coverage, directors and officers liability insurance, where if they are liable for any of their actions, they need some kind of coverage to protect themselves. So typically when an officer joins a company, the first question they are going to ask is the company having directors and officers? Otherwise what could happen is they could be personally liable, the money could come from their personal bank account. So it's very important we have this coverage. Most of you could ask, why do we need separate directors and officers? If you closely look at the general liability policy, they exclude these coverages because it's very unique. So that's the reason why it is very important that we have this coverage. The second kind of insuring agreement is employee practices. When I say employee practices, we have a company and there are employees. There could be sometimes some kind of discrimination happening between employees for various reasons, or kind of sexual harassments or wrongful termination. An employee could be terminated for wrongful cause, and the particular employee could file a case against a company. So in order to prove that it's not something that is done purposefully, we have to use this coverage, employee practices liability insurance, which will cover all those exposures. The third one is fiduciary liability, right? Fiduciary is nothing but a person who is responsible for handling any benefits that particular company provides. For an example, 401k or health insurance, right? This person who is working on behalf of the company, if he does some mistakes, when I say mistakes, maybe when he's investing the funds which is used for the employee benefits in a wrong investment funds, and that results in a loss, he could be liable for that, or the employee could file a case against them. In those scenarios, we can use the fiduciary liability insurance, so it's basically any error caused in the employee benefits plan. Finally, crime insurance, most of you know what is crime. There is an employee who is involved in malpractice, taking away the organization money or some kind of issues related to money or securities, then we have crime insurance. So the reason why we have separate insurances, the general liability policy does not give coverage to those exposures, and they exclude those exposures. That is the reason why most of the clients, they package these 4 exposures into one policy, which is called management liability policy. Sometimes it is highly possible we can have directors and officers as a standalone policy, employment practices as a standalone policy, but general rule is they package all these exposures into one policy. It's not a true package policy, but typically it's kind of packaging different exposures together. I hope you like my training videos. If you like my training videos, please do subscribe to my YouTube channel. Have a great day. Bye-bye.